Usually I have like 100 people on call. So
Okay.
let's see how many people joining tonight. So
Yeah, cool.
I'm gonna share the link. 1 second. I'll post this in the YouTube on Twitter. I shared the link. I'm gonna tag you here. Gavin. Yep, it's all set. I've shared the link, so you can also share it to your community or your Twitter account, and then we are all good.
Okay.
Hi, Sven. Good evening. Let me just share the screen. I'll give the control to you once everybody is in the team.
Okay.
Okay. Just want to make sure that YouTube is catching the views properly.
Yep.
Hi, Sven. Hi, Arun. Hi, Kamal. So, guys, I have the opportunity to have Gavin. He's from Australia and he loves doing trading. So he'll be like, he's much experienced than all of us. So he's going to share with us his setups, his skills, something really interesting, which would really help us. So I'm just waiting for a couple of more minutes so that we can have more audience for him, and then we can like seize and go through his setups. All right. So please welcome Gavin onto the channel. And thank you for joining, everybody. Gavin, I'm going to give you the screen share. You can share your screen now.
Okay, thanks for that. Let me do that. There we go. Let me know when
I
you've...
can see your screen, yes.
Okay, great.
So let me just say hi to Raman, Naisa, M4660, Nag, Delta, Srini, Full, Lalita, Binayak, Sharab, Manjunath. So, Kevin, you can see the YouTube chat. Do you have multiple?
Let me see.
Because usually people will have their set of questions in the YouTube chat. Because I have a limitation with Zoom, I can only have like 100 people on the Zoom call, but YouTube is unlimited. Anybody can watch YouTube. Hi,
Okay.
Ryan. Hi, Ashish.
I don't see the comments on YouTube. Maybe I'm on the YouTube link, but oh, there we are. I see them. Sorry, my bad.
You got it?
Yep. Just looking in the wrong
All
spot.
All right, the stage is yours, Kevin. You can start.
All right, cool. Well, yeah, thanks for having me on. I hope I can share some good information with you tonight and help you with your trading. And if you've got any questions, just let me know. But I'll kind of walk you through some of the things that I do to find trade setups, and we'll walk through a couple of examples in terms of how I found them, how you'd set them up, and then how you would manage them from there. So I'll start with Adobe because that's got earnings later in the week. So basically, this is an earnings trade. It's a bit of a high risk trade. It's actually not too bad in terms of the capital at risk. I'm just using one contract here just to kind of, for example purposes. But when, I don't know how much your audience knows about options and volatility and stuff like that. So if some...
They're well versed, but again, there are many newbies as well. So if you were to like spend 5 minutes on just giving them an idea of what they are, like the Greeks and the volatility, that will be a good start for them.
Okay, sure. So when a stock or a company announces earnings, the implied volatility is really high because there's a big unknown event on the horizon, and we don't know, the stock can be quite volatile over that earnings announcement, right? And So the implied volatility goes up. And when a company reports earnings, the short-term options are impacted the most by that earnings announcement. So what we're looking at here is the different expiration dates through time. So short-term at the front and then going longer term on the bottom. And the blue line here is the implied volatility for Adobe. And we can see that options expiring this week have really high implied volatility up here around 75% because there's this big unknown event happening this week and the short-term options are going to be impacted the most. So there's a lot of volatility there. Whereas when we go further out in time, the volatility settles down a little bit and comes back to a sort of normal range of 30 to 35. And we can see that if we look at it another way. So that's as of today. That's what the term structure looks like as of today. If we go and look at implied volatility over the last, I'll just change this to 12 months. So this is what the general implied volatility was for Adobe stock, back in December, March, all through time. And you can see that there's this common pattern, and you're going to see this with most stocks where, there's a rise in implied volatility into earnings, and then we get the earnings announcement, and there's this phenomenon called IV crush, where the implied volatility really drops because they've released their earnings, the uncertainty's gone, the volatility really comes out. And you can see it happens every quarter. We get earnings, we get this big IV crush. Does that make sense? Do you guys kind of know all that sort of stuff? Or yeah?
Yes.
Okay.
But this is the first time I think I kind of use this volatility in numbers, but first time I'm watching this in the graph. It's there, and I use Think or Swim as a tool. It's right there, but I always use in a tabular format than in graphical format. But graphical gives a very clear picture of how.
Yes.
Yes.
Yeah, definitely. So we can see the general level of implied volatility at the moment for Adobe is about 34%. So it's not as high as it has been in past earnings announcements, but it's still pretty high, and it's higher than what we normally see. And we're expecting that we'll see that volatility drop after earnings.
Okay.
And so we can see in our, this is called Risk Navigator. This is with Interactive Brokers, the broker that I use, and they have an analysis platform called Risk Navigator. And it's similar to Think or Swim's Analyze tab, where we've got in the bottom section, we've got our payoff graph with the blue line is the profit and loss at expiration. And the purple line is what we call a T+0 line, or a trade date plus zero. And it basically just means, how does the trade look as of today? If Adobe goes up, we make money. If it goes down, we're going to lose a bit of money. That doesn't take into account any change in the other Greeks. But the other thing you'll notice here is the implied volatility column. So we've got Adobe stock around 34%. We saw that on the graph. But these short-term options have actually got implied volatility of about 64%. So very, very high implied volatility in these short-term options. So what I'm looking at here is basically a bull put spread, where we sell an out of the money put, and then we buy a further out of the money put to cap the risk. So it's kind of an income trade where, if Adobe finishes above 530 this week, the whole structure will expire worthless. We'll make about $75 per contract. We're risking about 425. So what's that? 75 over 425. It's about a 17.5% return for the week.
But will not that be a risky bet? Because in case if it goes down, then we have to end up paying that much.
Yeah. So if it goes down below 525, we lose 100%. We lose the 425, right?
Yep.
So that's the risk. There's always risk, of course.
But the risk reward is not so great in the situation, or you just feel comfortable that yes, Adobe is set up for.
Yeah, that is true. But I mean, I don't know if most of your traders are more swing traders. You want to risk a little to make a lot, right? Whereas with options, we kind of do the opposite. We're risking a lot to make a little, but we have a high success rate because most of the times Adobe is going to stay above 530.
Okay, fair enough.
Yeah. And if we There's also a concept around earnings called the expected move. And I won't go into detail on how it's calculated, but you can get it for free at a website called Market Chameleon.
It's there on Thinkorswim. Like if you go on any option chain in Thinkorswim, we have that market move. So
perfect. So you can just get it from there. So we can see it's 5.4% is the expected move over earnings. So if I just do a quick calculation in Excel, the stock's at about 562.25. Expected moves 5.4%. So it's expected to stay above about 530.
Got it.
Now sometimes it does make a bigger than expected move. And we can see the history if we go back here. I don't know if Thinkorswim shows this, but we can see the last 6 earnings announcements here, and we see that there's only 1-2 times where it made a bigger than expected move on the downside. So it's a pretty high success rate.
Fair enough.
Yep. So it's a bit of a hit or miss trade. There's not really many adjustments you can do here. But anyway, I wanted to share that one with your group. That's kind of one that's a pretty standard type of trade over earnings, taking advantage of that volatility.
Tell me one thing here, Gavin. It's a credit put spread. Can I also do a credit call spread on the 30 plus size on the higher side, like 590 call I'll sell and buy a 595? Get a condor. That will bring my cost down.
I'll show you how to do that. Oh, so you want to do a condor, all right? Yeah, okay. I'd try and keep the delta pretty similar. So you've got a 15 delta here on the short put. We're not getting data here on this one, but that's probably the 15 delta there. But I'm going to get an error if I add that one. It's a bit annoying. So I'll do an 18 delta. And I think what you're saying is if we sell the call spread as well, it becomes an iron condor, yeah.
Will not be that'd be a perfect situation, because then I reduce my cost, and if it remains within that $30 threshold each side, I'm going to make money on both legs.
Correct. That's right. So yeah, you can absolutely do that. I'm just going to change this around a little bit.
Okay, I just make a note of this on my end.
Sorry?
I'm just making a note on my end that on Adobe's earning, I may play this. Yeah,
sure. So yeah, what you're suggesting here is we add the call spread as well. It makes it direction neutral. So we've got 0 delta. The advantage of doing this, as you said, we've increased the premium received. So we get some extra premium from selling that call spread of about $65, takes us up to about 130, 140 premium received, and our risk is lower. So yeah, that's absolutely what you can do as well, if you don't want to take that bullish directional bet.
Yep.
So yeah, that's one way that we can trade earnings. Has a pretty high success rate.
That's good. So let me just check with the audience, guys. Any questions with this understanding? Because this is completely new, like how we approach the earnings by looking at the previous implied volatility of the stock and then comparing the volatility with the option and then playing on the deltas. Gavin, it's going to take a minute because there's a lag between what we say and what comes on YouTube. So we even have to, and in between we have 105 people joined us live. Thank you for joining in, guys. Okay, so that's interesting. And you also like you prefer these like short trades because where the stock move is in a specific direction, and then you try to do credits put spread or credit call spread, because that gives you money.
Yeah, I mean, short-term trades can be quite risky. We'll kind of talk about that when we look at some other examples. So you have to be willing to sort of accept that risk. But the advantage is you're getting a lot of time decay. So we have positive theta. So the short-term options decay really quickly. So we're getting that benefit from time decay. The trade-off is we have, the price risk, the P&L can sort of move around pretty quickly on these shorter-term trades. And they also don't allow, or they're harder to adjust than longer-term trades. So it's kind of a bit hit and miss. But yeah, this is a pretty popular strategy over earnings. Yeah.
I prefer doing butterflies, especially broken butterflies, because
Mhm.
that gives me like both ways. And if I'm like directionally right, I make really good money on butterflies. So we have a couple of questions from the audience. Number one is Justin. He's asking, what is the requirement for an iron condor? Any capital requirement, or do we need to own the stocks?
You don't need to own the stock. You just need to have level 3, I think, option trading permission. The capital requirement is this, what we see here on the blue line. So about $360 capital requirement. That's the most the trade can lose. So that's really the only requirement. So you can do these type of trades with a pretty low amount of capital.
Right.
Good little test trades with one contract. The worst that's going to happen is you lose 360. So it can be a good way to sort of learn. There is a tricky situation where if on the Friday the stock is sitting between the strikes, between 530 and 525.
Yep.
Doesn't happen very often, but you could potentially get assigned here on the 530 put, and the broker's going to buy 100 shares on your behalf, which is obviously 53,000. But then you can just turn around and you're going to get a margin call. It can be pretty scary. But you can pretty much just turn around and sell those shares straight away and reduce the margin call. But yeah, that's a little tricky situation that I just wanted to point out. Doesn't happen very often, but just something to be aware of.
Like especially happened with me on SPY calls, and that they get even assigned before the Friday. They got assigned to me on Thursdays sometimes. But
yeah.
Yep. So
Yeah, that can happen.
There's one more question. Like somebody's saying that he has tried diagonal trades. We'll come to diagonal trades once you go into example. There's one more interesting question. Can we take advantage of IV spike before the earnings? Like not on after the earnings? Like can we find something where we can actually use this IV going up, helping the premiums into the options?
Yep. So there's another strategy that you can do. So when you see periods down here, early July, where the IV is really low, and you know that earnings are coming up, that volatility is going to start rising soon, you can look to go long volatility here in this period and try to benefit from this spike in vol that we know is coming. So that could be via a long straddle or a long strangle where you're buying a call and a put, kind of the opposite. That can be a good thing to do as well.
Yep. Again, I used to remember this on my sheet that yes, the earnings are coming. Let's go buy some calls so that we can have ER run. But with implied volatility adding to the premiums, that's a really, really good way of approaching into the ER. Thank you for this.
Yeah, I've written about it on my website. I'll drop the link here as well. See if I can do that in YouTube. If you want to read a little bit about that strategy.
Yeah, you can post that onto the YouTube chat, and I'll put that on Twitter.
Okay, cool.
Thank you.
But yeah, good question there.
Yeah, you can move on to your next.
Okay, cool. Sorry, I meant to just have a quick disclaimer at the start as well that everything's for general purposes only, does not take into account anyone's financial circumstances and educational purposes only, of course. But yeah, I meant to say that at the start. But let's move on to.
I have that covered in my description, so don't worry about that.
Yeah, cool. So Meta is another one. This one I found. So this is more of a longer term trade, so out to October. And I'll show you a couple of scanners that I run on bar charts. Can't remember where this one came up. So this is a 50-day moving average screener. So I noticed here that out of the big large cap names, there was some 50-day moving average crosses. I looked into a couple of them. Meta had a bullish cross. And when I came and looked at the chart, it looked pretty promising. Nice little chart pattern here where it's breaking back above the 50-day moving average here. So nice little bullish setup and similar story, bull put spread. I don't think we have to worry about earnings with this one. I could double check the date, but I don't think earnings are before October 20. 17 delta.
It should be after. It's usually in like fourth week of October. So
yeah,
it'll be good.
Yeah, exactly. So a similar idea, selling a 15 delta put and then going out and buying the protection 5 points lower, generates about $80, 420 at risk. Now, with this one, because it's a longer term trade, it is going to move a little bit slower, which is kind of good. But we can withstand a move all the way down to 280. But what we want to do is not let the stock get too close to 280 before we think about doing an adjustment. So with a trade like this, what I do is I follow this T+0 line until there's a loss about equal to the premium, about $80. And I set a price alert, somewhere around here. I'll probably go to about 295. And if Meta hits 295, I'm going to take some action because I don't want to start losing too much money. So yes, it's risking 420, but on a trade like this, I'm never going to suffer a full 420 loss. I'm always going to either hedge, adjust, or close when we get to about here, 295.
Okay.
And if that happens tomorrow, the trade's going to be down about $100. But if we change our date to be more towards the end of the month, it might only be down maybe $60. Oh, actually, that was 50. I was looking at the wrong line. So it's only maybe down $40 if it hits 295 at the end of the month. So it's not such a big deal. But the main factor with a bull put spread like this is we never want to let the stock get below 280. We always want to take some action. We want to close it out or we want to adjust it well before it gets to 280. And in this case, I'd sort of say about 295 is where I would either hedge, adjust, or close.
And one question here, like you decided 280, 275 based on the like market move or based on the delta?
This was based on the delta, yeah.
Okay.
Usually around that 15 delta is going to be just outside the expected move as well. But yeah, I'm pretty consistent with that sort of 15 delta being where I would enter them in. I've got another one here that we can look at just if people want to be a bit more aggressive. We can see a slightly different trade here where we're using a 26 delta and we get a bit more of an attractive reward to risk ratio where we're generating 120, risking about 380. So that is a much better risk to reward ratio. But the difference is we don't have as much margin for error. We can only, the stock needs to stay above 290 in this case. Right. And if I'm going to adjust before it gets to 290, maybe I'm going to adjust at 300. It doesn't really give us a lot of room on the downside before we're having to adjust.
And like, will this strategy be fine if I do instead of going 1 month or 2 months long, maybe on 1 week from now options, because then the delta will be higher and theta will also be higher, but the risk reward will be a better. Because I do that thing going by this week or maybe next week. So what's your thought on that?
Yeah, I mean, there's nothing wrong with that. They do move a bit quicker and you have to kind of really monitor them a lot more. Whereas with a longer term trade, they don't need to be monitored quite as closely. But, let's say we wanted to go a 15 delta for next week. Where's that going to be? About 290. So it's actually not too bad. If we compare this one with this one, we're only getting an extra 10 points lower going almost a full month extra. So yeah, if you have the time to monitor these and to watch these, sometimes the shorter term trades can be better. Just reset this, it bugs out sometimes. The reward in this case is slightly lower, only about $50, $55. But yeah, you're going to make that or potentially make that profit in 1 week rather than having to wait, 5 weeks or so.
Yep.
So much higher return potential, but I like to tell people, finance 101, high return usually goes hand in hand with higher risk, right? So not saying one version is better than the other. It's kind of personal preference and how much time you have to monitor these. For me, it's quite difficult with the time difference being in Australia. So I don't like these short-term trades because it's just, they're too hard to monitor. For me, I prefer going like a longer term trade and we can kind of see the difference there, much flatter T+0 line. So let's say we get the direction wrong, Meta drops to 290, let's say, in the next week. The long-term trade is going to be down about 100. The short-term trade is going to be down about 160, I think. 290, 140.
140.
So yeah, so not too much more. So, but like I said, it's partly a factor of time and how much time you have to monitor these things. But yeah, a lot of people do prefer these shorter term ones because you get the higher theta, so more time decay. We're getting $4 per day in time decay, whereas here we're only getting $1 per day in time decay.
Yep.
There's always a trade-off with options. So I'll change these contracts to be quite large just so we can see the Greeks in a bit more detail. So the trade-off with the high theta is high gamma. So our gamma is 3.5 times or 3 times more on the short-term one than the longer-term one. And gamma is just basically price risk. It kind of shows you, it measures how much the delta is going to change based on a particular move in the underlying, $1 move in the underlying. But you can think of it as basically how quickly your P&L is going to move depending on a $1 move in the underlying. So your profit or loss is going to move 3 times quicker on this short-term one compared to this one, roughly.
So, coming to this gamma thing, my understanding about delta theta is pretty clear that $1 move in underlying equity will show the price move based on the delta.
Yeah.
Theta is the decay of the option price per day. Gamma,
Yes.
my understanding is how quickly it changes the delta with $1 underlying move, right?
Yeah,
It's going
correct. Yeah.
But like then people talk about that there's a GEX, there's the gamma squeeze. I'm not able to understand that at all. That what is GEX and how it is pinned to that number. Do you have any idea about that? Like, it's Twitter. People post that yes, GEX is this and that. I have no idea about that.
Okay, so yeah, it's quite a complex topic. But basically, if the market makers are, if a lot of people are buying options on, there was a big gamma squeeze in GameStop a couple of years ago, right? People were buying lots of call options. The dealers end up with a lot of short delta because they're selling those call options to the retail traders. So then they have to buy the stock to hedge their delta. So basically, it's kind of a snowball effect where retail traders buy call options. That leaves the market makers with short delta. So they then have to buy the stock to hedge their delta, and then the stock keeps rising. And that's kind of what a gamma squeeze is, even though we're only kind of talking about delta, but the gamma is a factor as well. But that kind of becomes self-fulfilling or a bit of a snowball where, the more call options get bought, the more the market makers have to buy the stock to hedge their delta, so the stock keeps rising.
All right.
Does that make sense?
Yes, but like I'll dig in more into this because I want to understand exactly how they set it up. Logically, I have an idea, but I want to practically test some examples and see how I like. Right now, you're just showing me hypotheses, right? Where I can test with data and see. I just want to try that GX, but I'll do that. Thank you for this.
Yeah, sure. We can chat further about that offline if you want as well.
Yeah.
Okay, should I go through to the next example, or was there some questions?
Guys, any questions here with respect to using Greeks in meta example? Again, there's a lag, so it's going to take a minute to reach the audience. I'll suggest you can move on to your next setup. By the time the questions will come, I'll read out to you.
Okay, sure. So another one is Nike. So they've got earnings as well later in the month. So another scan that I like to do is just on stock charts here. You can get a small thumbnail view of all the Dow Jones stocks. And I like to look for, quality blue chip companies that have been beaten up a little bit. Walgreens I'd kind of avoid right now because that's just in the dumpster. But Nike's a quality company, Boeing's quality company, JP Morgan. You don't see these stocks being in this oversold region for too long. So then I'll kind of drill down into the individual name and take a look. And yeah, the chart's pretty bearish here, but we can take advantage of the volatility and also potentially buy the stock for a bit of a discount by selling a put option and taking advantage of that high volatility around earnings. So if we look at Nike volatility, we can see it's starting to get high, it's starting to come up into earnings. We can see we get this IV crush every quarter. And if we go back here, so September 29 is after the earnings. So we've got the high volatility here, not as much of as much skew or inverted term structure as we saw with Adobe, but still pretty high volatility on those short-term options. If I sell that put option, this is probably pretty familiar to most of your audience. I generate about $230 in premium. And if the stock goes below 95, I'll have to take ownership. And then what I do from there is begin selling covered calls up at, say, 100. So our break-even price is about 92.8. And what I do is I have a little analysis spreadsheet here. And basically, I'll provide this after the class if you like, but just fill in the green cells. So we change our expiration date. The stock is at 96.79, strike price 95, and the premium is about 230. So we can see here that we've got a 4% decrease to our break even, and we get a 2.5% return if Nike stays above 95 between now and the end of the month. And that equals a 50% annualized return, which is quite high. So So that's something that I would look at if I was happy to take ownership of Nike for the long term. I'd potentially look at selling that put option, try to buy for a discount. Your net cost basis is 92.70. And then from there, you can sell covered calls. Not sure if Nike might pay a small dividend, but probably not much. But while you're holding the stock, you're collecting any dividends and you're selling those covered calls as well. So that's a very common strategy that I'll employ. And then what we're looking at here is taking advantage of that higher volatility because of the earnings announcement.
Okay.
The other one I've got here is just going out longer term and looking to buy a put option as protection to hedge the downside risk a little bit. So we can see that drops our delta from 38 to 26 without too much of an impact on our theta. So that's just one way to manage the risk a little bit. You can see if we get the worst case scenario, Nike has a big drop, without the hedge, it doesn't make too much of a difference, but it's more so if it has a really big drop down to 70 or something like that, would be a bit of a disaster. There's a lot of risk there, but if we have our extra hedge, now we've cut our risk. Still pretty bad, but less than it was. So that's a little addition that you can do on those cash secured puts over earnings.
Okay. So I'm just trying to bring my thoughts on I understand that you did a sell 95 put, which covers the earnings, and then you did 80 put for January so that it's a hedge to your position. Correct?
Yeah.
Why don't you did a 95-90 put spread directly so that you have a limited loss?
Yeah, you could do that as well. I just wanted to try and show a different example.
Okay.
Because we kind of looked at that already with Adobe. The advantage of going longer term and out to 80 is where the one that we're buying has less volatility. So we're getting cheaper volatility that we're buying and less time decay. But yeah, you could absolutely cut the risk. The biggest way you could cut the risk would be to buy this September 29 90 put. So rather than that one, you buy that one, and yeah, massively cutting your risk. You're still getting a pretty decent return.
Yep.
And so yeah, I like doing that. And what you can do in this scenario, if Nike does happen to drop below 95, I'd maybe sell this put option and just let this one get assigned if I wanted to take ownership.
Yep.
Yeah.
I do that.
So that's a really nice strategy.
Yeah, I got a couple of questions from the chat. Are there any particular adjustment strategies to avoid a loss if stock moves in a wrong direction in credit spreads?
Yeah, so this one is pretty close to the money, so it's a little bit harder to adjust. But if we go back and look at the Adobe one, this one in short term as well. So you know what? I'll use Meta as an example. Sorry, jumping around a bit. Okay, so what we're saying is we get the direction wrong. Meta gets down here, it gets to our decision point or our alert point. You know, what can we do to try and mitigate the loss? Well, as Naval said before, we can add a call credit spread, which can help increase the premium and cut our delta risk. The other thing we can do is roll down in price. So we could take this 280, 275 spread off, roll it down 5 points. That's kind of the most common. You can potentially roll this out to November as well if you want to buy yourself a little bit more time. So there's quite a few different adjustment strategies that you can use. Can't really go through them all now, but if you want, I can send you some reading to do on adjustment strategies if you need some further info.
Okay. Then Harsh is asking, iron condors are neutral. Yep, that's true. How can we chart the IV of a specific stock like Gavin is doing Nike in TOS? Do you have TOS, Gavin?
No, I don't.
Okay, so Sonu we'll see how we can do this in TOS.
Yeah, I'm sure you can, and someone else there saying
no, it's there. Let me just I'll stop sharing your screen. Let me just try sharing TOS, and then we can check if we have that. So we have analyze option and probability analysis and risk profile. So these are the options. So let's go with Adobe. Now we can choose like it's something like this where we have the percentages here. I've never done this, what you showed us. So think back. No, I think this should come under probability analysis or in the money, out of the money, touching. This is volatility. It does not show me the historical one. It shows me from current to the future. Wait, I'm not sharing my screen. Oh, I'm sharing my screen. So this is a little different than what you showed us, Gavin.
Yeah, it's quite helpful. This is basically showing you the expected move across different expiration dates. So it's actually quite helpful. But yeah, it's different to the IV chart that I was looking at before.
Yes. Let me see any IV charts, risk profile, expiration, plus 1 day step. I think this is something in the money. I'm not right. So I'll not waste this time. I'll give it to you. We'll check on this later on.
Okay.
Thank you. You can share screen.
Okay. So a couple more to get through. So Tesla, everyone's favorite. So this one is what's called a broken wing butterfly.
I love these.
Yeah, so these are a great trade. We have a really flat T+0 line. We've got a small income potential. So basically what we're doing, we're buying just below where the stock is. We go down 10 points, we sell 2. and then we go down 15 points and buy 1. And that's how we get this broken wing shape, where there's a little bit more risk on the downside than on the upside. And in this case, we've actually got a little bit of income potential if the stock rallies or stays flat. So it's generating about, let's say, $55 with $4.45 risk. It's about a 12% return if Tesla stays above 270. And then we've got this large profit zone or profit tent below where the stock is trading. You can see if the stock drops today or tomorrow, we're going to lose a little bit of money, even if it is in the profit tent. But the idea is that as we get closer to expiration, out to the end of the month, no, I'll have to go a bit further. Let's say the 6th of October. Normally we see a bit more of a rise here if we're in this zone here, but you can see it's going to do better if the stock rallies. I'll change this just to right before expiration, say the Monday before expiration. You can start to see how we're looking pretty good in this zone here. What you can do with these ones as well, if you want to be a little bit more further out of the money, we just move everything down 5 points. Actually, I've got slightly wrong strikes here. So just bear with me a sec. And then I need the 240 put, not the 235. -2. So that's giving you slightly more margin for error on the downside, still maintaining that profit tent and still got a little bit of income potential. So that's a really nice trade. And then there's things you can do with these in terms of, when you get closer to expiration, you can start to lift the right side of the graph up a little bit and lower the back side of the graph if the stock's staying up in this upper level. Bit of more of an advanced trade. But those are really nice ones to do.
No, I love doing them. Like, I love broken butterflies. I
Yeah.
make good money on them.
Yeah. So yeah, they're one of my favorites, particularly at the moment. They're working really well on Tesla, on the indexes as well. Like, there's a big, large trade on the Russell called the Rhino that a guy named Brian kind of invented. So that's a really good strategy if you're interested.
Sure.
You can learn about that one. Yep.
Sure.
I'll drop a link in there where you can learn about that one.
Or you can drop the link into my messages. I'll share with the community. Because
Okay,
YouTube
cool.
chat, nobody's going to come back.
Okay.
I'll put that on Twitter as well as on my Telegram.
Okay, cool.
Thank you.
So any questions on that one in terms of the setup or the idea behind that one?
No, not from me. I think
you're pretty comfortable with those ones by the sounds of it.
I'm using broken butterflies for like almost 5-6 years, so I love them.
Okay, cool. So yeah, do you do them on Tesla?
I usually do that on earnings. I look at the technical chart for the direction, and then I try like 5 to 10% of the strike prices difference as my cost. So if there's a difference of 10 strikes, I try to buy the broken butterfly around 40-50 cents, so that if it works out, it should give me at least $6-7. So I go in like with 10 or 12 dots, $500-600 risk. If it works out, it works out really, really well.
Yeah. Perfect.
So there's one question. Does this strategy work on stocks like Tesla, which can move 10% in a day?
The broken wing butterfly we're talking about?
Yes.
Yeah. Yeah, it works on Tesla. I mean, you can see here, even if it drops 10%, if I change this to percentage, I don't know how well you can see this. worst case, it's going to be down about 140 if it drops 10% tomorrow. So that's obviously the worst case scenario in some respect. I mean, I could drop more than 10%, I guess, but that's the risk, is on the downside if you get a big move like that in one day.
Okay. So, Rohit, yes, it covers. It totally depends on how you are defining your legs into the butterfly. If your legs are clean and you have a clear direction set up, you're covered. You will only lose the max premium you paid in these broken butterflies. So your risk is relatively really, really less. All right. Do you have anything else to share, Kevin?
I just saw there's one other question about how do we choose the levels and why are we using puts? So it's a couple of good, really, really good questions. I always try and put the profit tent just slightly below where the stock is. A lot of times you might see the stock rally up a little bit and then pull back into that zone as you get towards expiration. So I like to have that profit tent below where the stock is. And what was the other question? Why am I using puts? Okay, so because we've got a short put, we've got short options here, we always want our short options to be out of the money. And that helps to reduce assignment risk. If I was to use calls here instead, the structure of the trade is going to look very, very similar, almost identical. But that 255 strike, if that was a call option, that would be in the money, and then it would be subject to assignment risk. So anytime you've got a trade like this where you have a structure with a profit zone below the market, you want to use puts to avoid assignment risk.
Okay. What delta for the BWB?
Somewhere with that middle strike around a 30 delta is pretty good. So what you want to try and do is you want to try and find a structure where that looks good, rather than worrying too much about the Greeks. Sometimes you want to have this upper side of the graph above the profit line. So no matter what happens, you're going to achieve a small amount of income. Sometimes you might have this line come down a little bit lower and have a little bit of risk on the upside. It's just kind of tweaking things to find something that fits your outlook for the stock and what you're trying to achieve.
Josh, you need to try this out. Try some examples and see what gives you comfortable level, and only then you can go and try that with your real money. Because first of all, we need to find how to put this into Thinkorswim so that we can have a similar structure. I may need to spend some time on that, because I'm used to the tabular format and use the values, but this gives a really, really good picture. I think everybody is liking this. I have Interactive Broker, but I've never seen this piece there.
Yeah. So Thinkorswim has the Analyze tab. Do you use that? I know that's pretty popular.
I use Analyze tab. I use the option chain. I have add some customized column to figure out if there are more open interest for any specific option. And then I use strategies based on the high IV to beat out the premiums.
Yeah,
but again, cool. I do not use this graphical way to figure out what's the best possible move, but I do it from a tabular format of data.
Cool, perfect. Yeah, I really like looking at the graph and looking at the T+0 line, looking at how the trade's going to progress over time, and then monitoring the Greeks as well. So, I couldn't live without Risk Navigator. I really use this a lot.
I'll try that. I have Interactive Brokers. I'll check what is Risk Navigator, because the application which I use on Interactive Broker is totally different. Are you using a global application, or are you using the US based application?
Yeah, I think it's the same, but it's Trader Workstation.
No, they're two different applications.
Okay. Yeah, it's a desktop app that you download called Trader Workstation.
I use Trader Workstation, yes.
Yeah. Make sure you're using Classic and not Mosaic. That's a trap people fall into, or not a trap, but that may be why it looks different. Yeah.
I'll check. Sure. Thank you. Thank you, Harsh. I'll reach out to you how you can help me on setting up. Uh, this was really good, Gavin. This is really brand new information for most of us. We were
Mhm.
aware of this, but like the way you explained, the way you showed in a graphical format, that was like really nice. Thank you for this.
Yeah, no problem. You're welcome, and thanks for having me on. I'm glad you found it helpful.
Thank you. And if you'd like to like share what you do with the people, because now we have a larger audience, so that in case they want to reach out, guys, please follow him on Twitter. He is a much bigger accountant than me, so follow him. He provides so much of information on options. And if you want to spend like 2 minutes on sharing what you do, so that these people can reach out to you.
Yeah, sure. So I've been trading options since 2004, and I've been teaching other traders since 2010. So I've been at this quite a while. My main website is Options Trading IQ. I run a couple of courses throughout the year. I'll run like a 1 month course more for kind of beginners, going through the basics, and then we look at sort of 6 or 7 different strategies and go through the trading plan of how to set them up, how to manage the trades, and then we'll look at some live examples in the market and kind of follow those through. Then I also run a 12-month program, which is a little bit more advanced for people who, you know, are pretty experienced with options and Greeks and trade setups. And, you know, we have a once a week webinar, we have a chat room, and we go through sort of 5 to 10 ideas every Wednesday night on the webinar, and then we follow those through. As they come under pressure, we talk through adjustment strategies and how to manage the positions. So, yeah, but also on Twitter and the website, you know, lots of free information to read through if you're interested. So, yeah, feel free to check that out.
Sure. Thank you for that, guys. Please check out his Twitter account and the website, because I think he is providing us a different perspective of all these things, because we were trading from a different mindset. Now having a visual impact of these things and using these Greeks into consideration specifically, right, in a pictorial format, it's really nice. Guys, any last questions for Gavin? Because I don't want to hold him. It's your morning time, right?
Yes. 1 p.m. now, so just after lunchtime.
Okay. I don't think so. We are getting more questions for you. Thank you. People are following you and they are saying thank you.
Awesome. Yeah, happy to help, and yeah, reach out anytime if you've got questions. And yeah, thanks for having me on. I really appreciate it.
Sure. And I'll invite you a couple of more times during the end of like period of this year, so that once we try all these things which you have shared with us, we'll definitely try to discuss our outcome of those things with you, so that you can guide us better.
Yeah, absolutely. Yeah, happy to do that. That sounds good.
Thank you, Gavin. Thank you for joining tonight. Thank you for your
All
time.
right. Thanks. Take care. Talk to you soon.
Bye-bye. So guys, I'll be here and we'll be going through two things tonight, because we are short on time, is about ES and NQ chart, because we are really short on time. It's already 1 hour. So I hope you liked the new perspective. Ramakrishna, you can go to my Twitter. I just tagged him into this live session, so you'll find his name. So let's talk about ES and NQ very quickly. So ES today tried to break through this 4520 area, and then once it broke through, it almost came near to 4547. 4547 is a 61.8 Fibonacci area, okay, which is a tough area to crack. If we can clear 45, 47 tomorrow, then things will get better. If we get rejected, we should look out back for 44.58. That is the game. If we are rejected, we will be rejected hard. If we can clear, we can go higher. And I'm going to post all this in morning session because uh, I wanted today time to be spent with Gavin so that he can share new strategies, new approaches with us. So he gave us a new perspective that is very useful. So going forward, we should try and use the information which was shared to us. But right now, I'm just talking about ES and NQ very quickly for 5-10 minutes. And then I'll post the levels in the morning when I'm commuting to my work, probably around 8:30 in the morning. So we'll see ES and NQ level at that time. All right. So ES right now is trying hard, but 45, 47 is the number you need to keep in mind. If we get rejected here, like today, we could actually have a fake breakout and then we can go down and fill the gap. The gap is big. This gap is created because of the change in the futures from September to December. So we need to fill this gap. Similarly, we have a gap open at 43.25. CPI is coming. So CPI, I will share my views on CPI at 1 p.m. tomorrow. If I get, I'll host a Twitter space. I'll try to bring a couple of people and we can do some Twitter space on CPI. All right. Or maybe on Wednesday, because CPI comes at Wednesday in the morning. So Tuesday afternoon, I'll try to get some big people onto Twitter space, and then we'll talk about CPI maybe for half an hour, 45 minutes. All right. So for tomorrow, I expect, because we had a good clean day today, tomorrow I expect to remain choppy. We have an Apple event. Apple maybe sell on the news unless they do something magical to iPhone. I don't think so. Anything else is happening. We had a clean move on Amazon. We expected Amazon to move. So Amazon moved. AMD got stuck to 104 area. Amazon moved almost at 143 area. CAT didn't move. CRM started but never moved. Google in this range. Buy went 38.50. Meta, it went from 3.1 to 3.7. Microsoft 3.38. Netflix in the tight zone. Nvidia gave us 4.45. Perfect area. Oracle failed really badly. Snow did 170. Tesla 265.75. It opened at this area, so it was just a done for me. Zscaler went perfect. It went 165. So these things work. All we need to do is pick up one high setup move and then trade on that. So now I'll go into NQ. NQ 15606 was a target, 61.8. It moved up and today was the volume. And this happened because Amazon showed really good strength. Now, if we hold 15,606, we could move towards 15,750, 15,800. So keep an eye on 15,606. That's a very important level. Second thing, now we are far away from the EMA. Either the candle will come down or the EMA will move up. So I would simply say watch out for 15,606. All right. Now I'm going to share the Zoom link for a few minutes. Anybody who wants to discuss, you is more than welcome to join. Because I am running out of time today. Sorry about this. But I hope this was useful. All of you got a new, and I try to bring more and more experts so that we can have a different perspective and a different mindset, learning from the experts. I'm waiting for guys. If you're interested to join the Zoom call, I will be here for 5-10 minutes. And thank you for showing some real interest in the last few days. I see more than 100 people joining every night, which is really wonderful. And it gives me motivation that yes, people are interested to work, spend time, and it's going to turn around and give you good money. So I appreciate you all doing this. And having 100 people for an hour, it's really good. All right, I don't see anybody joining in tonight, so thank you. I'll post the levels for ES and NQ tomorrow morning. But if you have any questions related to Gavin, you can ping me on Twitter or in the Telegram community. I'll be redirecting you guys to him directly. And any link which he has shared, I'll be forwarding that to you all. Thank you, and have one person has joined. So I was about to sign off. So
yeah, Naval Bhai, will you be doing the levels today for the stocks?
no.
Okay. Can I request you for NVIDIA, please? Levels?
Yeah, I was about to shut down NVIDIA. 456 is the key. Today it came, made a bearish engulfing again. Lost 456, came to 435 and then bounced. Now, unless and until it does not close above 456, it's a sell on rise to me. But if it takes over 456, it will shift its momentum very quickly to the positive side.
So what are the levels for the positive side you'd see? And
above 456, it will run.
Okay. And on the negative side?
Negative side, it needs to break 435 area. 445 it came. It needs to break 435. If it does, then next level will come. Otherwise, it's going to take more sentiment in the market to bring it down. Right now, it's holding. It's trying to give up. It already came from 500 to 445. That's like a 12% down move. Now, for further down move, it needs some push, some negative news. Murli, the links are on Twitter. If you want to join, go into the highlights.
And Naval Bhai, do you have a bias for tomorrow for this NVIDIA or no?
I'm just telling you, 456 below, just shorted. Above 456, it will run.
Okay. And the level is 473 above that, I see.
473, 490, it will test.
Okay.
Raghu, you want to say something? Go
Yeah.
ahead.
Hi, Naval. Naval, like I posted on Telegram channel, like changes in the open interest, like is there a good way to see the buying the options or selling the options?
Changes in
open interest with the actually I posted a one chart I had prepared on that our Telegram community.
Okay. Chart.
An Excel file chart snapshot of that.
Yes, this is how it change in open interest up, net premium up, call. No, this is not complete.
Not complete. Maybe maybe if you're ready, we can discuss maybe some other day or something more on this.
Yes, it needs 4 factors. You're only covering 2.
Okay.
I'll do that maybe later.
Yeah, later, not
Yes.
for urgency. Thank you.
No problems. Thank you guys. Thank you for joining tonight.